What's up, YouTube? Silver Dragons here, and today I'm joined by Lior Gantz, the founder of Wealth Research Group. Lior, how you doing today?
I'm doing good. I'm doing
Awesome.
good, but silver isn't.
Yeah, silver. Wow, it's been a crazy last year or so. I mean, in August of 2020, silver was at 29.40 or something. It was crazy. And now we're like 22.40. So we're down about $7 in around a year. I mean, this is insane. What do you make of all this?
Silver is trading within a range. And the range is between 22 and a half and 29 and a half. That's the resistance and the support. It's a $7 range, like you're saying. And what I've been watching and looking at is that where it plays around that range. During the January 2021 squeeze on Reddit and Wall Street Bets, it really tried to burst above that resistance level into the 30s, and it couldn't. I'm talking COMAX, not what you got, what people pay on the physical. And then right now, it's crashed to that support level. It even broke below that. It went right near that 22 and came back to 23. Now it's fighting. There's so much algorithm action right at that 22 and a half because that's the support. So what's going on? Why is this happening? July 2020 was the best performing months for silver since that 1980 breakout to 50 an ounce. It was just an incredible month for silver. It brought so much attention, so much volume, new traders to it. And in August 2020, it hit that high on the same day that bond yields hit a low. And bond yields correlate a lot with the price of gold and the price of silver because the bond yields, the treasury bonds, they're the barometer for all the asset classes in the world. If the 10-year bond in August 2020, August 6, 2020, was yielding 0.5%, and you got inflation, CPI, at 4 or 5 or 6%, we have a very negative yield environment. But then once yields bottomed in August of 2020, they started to rally, and they rallied 200% until February of 2021. So that crashed gold and silver between August and February because yields were coming up, real yields. So they became less and less negative. And then the idea started to run through the markets. Well, what's next? Because the 10-year bond, once it goes to 1.7%, which it did in mid-February of 2021, that makes it the most lucrative and exciting and amazing bond yield for any developed country. Even though it's pathetic, right? 1.7% for 10 years, you're definitely losing money to inflation. Still, if you look at like Germany, Japan, Australia, all of Europe, if you look at any of the developed nations, when their governments issue bonds, it's either straight out at 0% or negative. Literally, you're guaranteed to lose money. So 1.7%, the United States is giving you a bargain. So there's so much money flooding into those bonds that it creates a top for the yields. And that's what we saw. But then the markets were like, okay, well, what's going to happen now? Is it going to crash back down? Or is it going to float around? All that uncertainty created a sell-off in gold and silver, because if there's no certainty, if there's no real trajectory, then it's very hard to judge what a precious metal is worth, because the price of gold and therefore the price of silver is a derivative of everything else that's going on. If there's a hot stock market, then less people are interested in precious metals. If there's low inflation or transitory inflation, less people are interested in precious metals. If Bitcoin and cryptocurrencies are going up like crazy, then less. It's a derivative of all these other things. If you remember in 2016, the last big bull market for gold and for silver, the markets were really bad. The markets were in a correction between January and August of 2016, and that's when gold and silver rallied, and the gold stocks and silver stocks went on a tear. They went up 5, 6, 700% in mere months. And so gold and silver are not in they're not trading in a vacuum. They trade as a comparison to other things. When you have a finite amount of money to invest as an asset manager, an institution, a sovereign wealth fund, a government, and you need to allocate those funds, then gold plays a big role. For institutions, silver also can play as a role, but they're competing with other things as well.
Now, real quick, Lior, I want to talk about gold and inflation. I know that's really confusing for a lot of people, and we need to cover that. But first, you mentioned the support for silver. It's around 22.50. What if that support falls out? I mean, how low could silver go?
So because the length of this range is between 29.5 and 22.5, the size of this range is $7, which means if it falls below support decisively, so if it breaks below 22.5 decisively, then the downside potential is $7. It can go to $15, which is right around where the median global mining output is. So it's about $13 an ounce to produce an ounce of silver. So it has that lower bound around that $13. That's really as low as it can go before a lot of miners start losing money and shutting down mines. And so when you saw, like in March 2020, when did silver bottom? It bottomed at $12, right at that area where miners could shut down production because they're losing money. That's the real that's the bottom for that commodity. And I don't think it's going to go there, but technically, on a technical analysis alone, just speaking technical analysis, it can go all the way down to 15. Do I personally think that that's what's going to happen? I don't. But if you look at probabilities and just technical analysis, you leave fundamentals behind anything else, yeah, that can happen. Just in the same way as if in January 2021, it would have broken above that 29.5, that $7 range would go up to about 36.5. So that upside plays just like that downside. In 2011, I remember silver was around 31 an ounce, and I got a report from Bernstein. It's one of the biggest analysis and wealth management firms in the world, and they said, look, when silver does this, it usually they looked at history and it falls to like 22, 20. They were trying to predict where it's going to go next because it was so hot, but the demand was so strong that they said, we actually do not believe technical analysis would be right. In other words, they said the probability is 80% that it's going to fall by 40% here, but we as a wealth management company, we actually are still bullish. And the day they issued that report, it started going from 31 to 33 to 38 to 42. I can't forget those days in 2011. The 45, it was unbelievable. And so silver has the ability to crash like crazy. It has the ability to go up like crazy. And really, what it really matters for silver is the dollar. The strength of the dollar or the weakness of the dollar is what really correlates to the price of silver. And with the Fed saying, look, we're going to start tapering, which means that they're going to buy less bonds and less mortgage-backed securities, or basically they're going to shrink the money supply, that creates a situation where dollars are more scarce. Also, you had this big Evergrande panic. You had the debt ceiling panic. And all of these panics, think about this. At the end of the day, and this is the same as in March of 2020, when you sell anything, what do you settle in? And what currency do you settle? You settle in US dollars. And so in March 2020, when everyone was selling their bonds and their stocks, you have to settle in dollars. That means there's a lot of demand for dollars. It's a technical demand. It's a short-term demand for cash. That same demand just happened now in September. So the weakness in silver is a short-term weakness because there's such a demand for dollars. Everybody's selling their stocks. In fact, 3 days ago was the second largest selling program in the New York Stock Exchange history. You saw about 99% of the companies trading on the New York Stock Exchange going down at the same day. So there was just an insane amount of selling. And because of the demand for dollars, that creates a lot of weakness on silver. So this is now where the true test is. Is all of this short-term weakness for silver going to translate into a long-term or longer-term situation, or is it going to bounce back? The Fed has already said we're going to taper. The Fed has already said that they're going to raise rates next year aggressively. So everything is out there. It's really easy now for investors to say, here is everything I need to know about silver. And what the Fed is going to do is here's everything I need to know about gold. Here's everything I need to know about the commodity sector. The only thing that's up in the air is inflation. Is it transitory? Is it permanent? Is it sticky? How long are we in this transitory phase? This, in my opinion, is what is holding gold and silver back. The investment community just doesn't know what transitory means, and it's waiting to see what's going to happen. I remind you that the Fed controls about 20 to 25% of the money supply and circulation. The rest is you and I. If we go on a spending spree, if we buy houses, if we buy cars, if we go out there and spend and create money velocity, there is nothing the Fed can do to stop inflation. They had to raise rates to 20% the last time that the free markets decided that there's inflation out there and we better buy things now than save.
Well, Lior, can we talk about inflation in regard to gold prices? Because this is something that I think a lot of people don't understand. I mean, there's this misconception that inflation is so incredibly high right now that gold should be going up, and it's not. I mean, August of last year, it was over $2,000 an ounce, an all-time high, and now it's sitting around $1,750. So what's going on with all this?
Gold correlates to real yields and not to inflation straight on. So inflation is one part of the equation. But if the markets believe that real yields are headed up, in other words, if they believe that the Fed is going to raise rates and create a situation where the 10-year bond goes to about 2%, where you're literally, as an institution, you're going to buy bonds, you're not going to buy gold, then they're obviously forward thinking and selling gold now in order to wait for the Fed to raise rates and buy bonds instead. Where the opportunity is if they're wrong. If the Fed will not be able to raise rates as much as they believe it will, and they're going to have to pivot just like they did in 2018. If that's the case, if they're wrong, then think about 1700 or 1750, but I think 1700 is a better way to think about it, as a base from which gold can start moving up again. Every time the Fed has raised rates historically since 1971, gold has appreciated by at least 30%. So they did one rate hike spree in 1972, one in 1974, one in 1979, one in 2004, another one in 2018 that ended in the monetary U-turn, where they said, look, we're on autopilot, we're going to keep raising rates, and the markets just fell 20% in December of 2020, when the market said, well, if you're going to keep raising rates, well, then stocks are not that valuable, because now there's an alternative. I can buy some bonds and and diversify. So that's what I think will happen right now, and I think it will happen way lower. Everyone in the world, corporations, households, everyone are addicted to a lifestyle of zero rates. If you start raising the price of money, it creates so many problems around the economy that what you're going to see is a huge crash, just like you saw in December of 2018. And so I think the market is wrong about how much the Fed can be aggressive with raising rates. And I think once they start raising them, gold has at least a 30% upside from 1,700. So 30% from 1,700 is about $500. That means, in my opinion, we at least, once the Fed starts raising rates, we're going to see gold at least go to $2,200, just on the most conservative scenario. So I think between now and when they raise rates, this is the time to accumulate. This is the buying opportunity. This is where you're going to get to buy gold before it's priced right. Right now, in my opinion, it's not priced right. It's priced in a way that over corrects for an aggressive tightening period from the Fed, which I don't think will happen. And once the markets figures out that it's not going to happen, I think gold will rally very quickly. And the same goes for silver. If the Fed is not raising rates that aggressively, then that means that it's going to be a weaker time for the dollar. And I think silver has the same type of upside as gold does, if not more. I wouldn't discount seeing during this rate hike period, seeing silver go over 35 again.
So if we're in a accumulation phase, which I believe we are in, I mean, I am still buying gold. I'm still buying silver. I feel like it's on sale right now. What should people be doing? Should they be, buying the physical, which obviously most of us all recommend, or how about mining stocks? Are those possibly on sale right now as well?
Well, different baskets, right? The different parts of the portfolio. For me, buying gold in physical form is something that I buy and I hold forever. I don't plan on selling any physical gold that I have ever. I plan to just give it to my kids when I'm done with the planet, right? So it's just something that I'll give that wealth away. And what I did personally is just calculate that if there's a scenario where we have a 2-year depression or a very steep recession, I want to have as much money as I burn right now on a given month times 24 months. And that's basically my physical gold position. I took whatever my household burns in 1 month, our lifestyle, and I converted 24 months worth of it to physical gold. That is basically my buy and hold forever gold position. On top of that, I took silver and I did the same thing, but with 1 year. So I basically have double the exposure to gold than I do to physical silver. And that goes right along with their long-term compounding effect, because gold is compounded at about 6.7% a year in the last 50 years, and silver has done half of that. It's compounded around 3.3%. So it makes sense over the long term to hold more physical gold than physical silver, all things being equal. Then if you're looking at something that's not physical, like mining companies, etc., then that's a different basket, because to me, all of these commodity stocks are very cyclical. They run from extreme busts to extreme booms. You have to catch that wave as much as you can. You don't catch the bottom, you don't catch the top, but if you catch the trend, then those tend to create huge returns in short amount of time. I can give you an example of a company in 2016 that I bought, for example, and it went up 1,200% between February and July, right? A silver company, silver miner. So the silver or the gold companies that actually do mining, if there's a rally, then that's something you should look at in your trading portfolio. Those in your audience that have way more time to look into companies and do research and can actually call companies and ask questions and do a lot of due diligence, they should also look at companies that are either in development stage or in exploration stage. Development stage means that they have a robust deposit of whatever mineral they're interested in, and it's an economic deposit. In other words, they've figured out how much it would cost to get it out of the ground, and they figure out that they can generate a profit doing that. That way, if the price rises, then obviously their deposit, which they've not spent a dime on, they're just sitting on that deposit, becomes even more valuable. And that's called optionality. That's a very leveraged way to make money, because that company will entertain bids or offers from the major miners and then sell to one of them at a great premium. That's a great strategy for an investor. But again, you need to do the diligence. The one business model that happens to work not in a cyclical way, not in a boom and bust way, is the royalty model. The royalty model tends to be very stable over time. And that's because the royalty companies, they're not really gold companies, or they're not really commodity companies. They are essentially a very stable way to collect income over time. Paul McCartney is the greatest example of this. Paul McCartney earns about $70 million a year right now. In 2021, that's $6 million a month, or $250,000 a day, from royalties on the songs of the Beatles that he authored and sang 40 and 50 years ago. So, Paul McCartney doesn't care about writing new songs. The royalty, the ownership of something that creates income is what he cares about. And that's why he can generate money 50 years even after he quit singing songs. The same thing these royalty companies do. What they do is they either loan money to miners or create some sort of an arrangement where they have upside in the project for a fixed price. They get to buy gold from the miners at a fixed price and sell it to the market at the current price. So they buy it very cheap and fixed, and they sell it later, or they get just a royalty off the top. It's called a net smelter royalty, and that is why the royalty companies have done really well over time. So it just depends what you're trying to do. The greatest royalty company of all times is a company that actually generated about 30% a year for over 2 decades. Just to give you an idea of how amazing that is, Warren Buffett became the greatest investor in the world for creating a 20% a year return for a few decades. So this was a 30% situation, and that company got bought out by Newmont and was then spun off in 2008, and I think it's up like 600 or 700% ever since. So the royalty companies do offer a tremendous upside as well.
Okay, so before we run out of time, Lior, I have to ask you just simply, are we in a bull market or a bear market for silver, and what about gold?
Yeah, we'll know in a few weeks for silver. I think, as you know, they don't have to do it together, right? Silver was in a bear market during the Trump years, while gold was in a bull market, right? The ratio between gold and silver peaked during the Trump years at 123-1. So, and gold obviously bottomed at 1,053 an ounce in December of 2015, and it was able to double. And silver, until it did that move in 2020, from 2016 to 2020, it did nothing. It basically traded in a little range. So this is not indicative of blow off tops for gold and silver. Silver has went from $1.92 to 50 in the 70s. It went from about $4 to $50 in the 2000s. For it to go from I think like 11 at the bottom to 30, that's usually not how these end. But it's gonna be decided in the next few weeks as we see what happens with inflation and everything else. For gold, I think the situation is a bit different because it became a tier 1 asset. It's different dynamics for gold and for silver. What I think is the best thing to do right now is do nothing. because you're gambling on whether or not it's in a bull market or a bear market. And gambling is not wrong. It's a strategy. You can speculate. That's fine. People do that all the time. They think they know the answer, and then they act on what they think they know. But what's better to do is to look at the catalysts for silver in the next few months until the end of the year, and figure out through those catalysts what's happening. You may get lower upside. For example, if you're right and silver is in a bull market and you buy now, of course, you're going to make more on the appreciation than if you wait for a confirmation. But in trading, it's not just the upside that matters. What matters is what's called risk-adjusted returns. In other words, how much risk are you taking for those gains? Because if you get lucky, it doesn't mean anything over the long term. Because you're at another point, you're going to gamble and be unlucky. And so what I'm personally doing is I want to see what the Fed says in December about rates. Between now and December, if silver has big crash days, in other words, if it goes from 22.5 where it is now towards the 20, I'll accumulate some. I don't care if it's in a bear market. 20 is a good price to pay for an ounce of silver regardless. So there's a technical side to this, and then there's a fundamental side to this. And so it has a price in my head where I'm saying I'm willing to pay for an ounce of silver this much, even if it's not the bottom. From a trading perspective, I would like to see it go back above the 25 before I do any trading. And so I'm not doing any trading on silver right now. And I think for gold, it's that 1950 that I care about. If it goes back to 1950, it's going to be the fourth time it does that. I think if that happens, it's going to go above 2000. On the flip side, if it goes to 1650, that's for me a red line. That means that it might be going into a bear market, and then I need to think in terms of what I want to do next. Again, physical, it doesn't matter. But as a trader, yeah, you're looking at all these kinds of things, especially if you're interested in mining companies. I think in general, just to wrap this up, all of the other commodities are doing very well. So for me to sit there and think about precious metals, especially silver, which is also an industrial metal, and to say to myself, well, those two are going into a bear market while copper, aluminum, steel, and all these other ones are zinc, etc., are going into all-time highs. It makes no sense. Natural gas. So I think in general, it doesn't make sense to me that they've entered a bear market, but I could be wrong. My idea here is to wait until the December Fed decision, unless something happens between now and then to see what's going on.
Awesome. Well, we really appreciate you coming on the show, Lior. Where can people find more information about you?
So wealthresearchgroup.com is the website. You can subscribe to the free letter. Also to the newsletter, I mean. Also on the top menu, you'll see a new button that we added that I think some of your audience might be interested in. It's called 24/7 Portfolio Live, and it's basically my portfolio in real time that you can enter and take a look. So you can see exactly what I'm doing with my own stock portfolio at all times.
Very cool. Thanks again for coming on. And for everyone out there watching, thank you so much. And I'll see you all in the next video. Silver Dragons out.